The Santa Claus rally officially began on Friday and it runs until Wednesday, January 3rd. And during this 7-day window, the market historically has the highest odds of all 254 trading days in the year to generate a positive return somewhere in the neighborhood of 1.32%. And technically speaking, that takes us to a new all-time high in the S&P 500. But if Santa doesn't come to town, it is possible we see less than stellar outcomes for the calendar year return. Although looking at this table, you can clearly see the large drawdowns only come from the dot-com bubble burst and the great financial crisis. Those are both scary. Everything else is more so manageable, and even an impressive 9.5% return happens in 2016, which falls into the quote average category of 8 to 10% annually. The main point we're trying to illustrate here is that the economic data would need to deteriorate substantially if we're looking for a rough 2024, which is currently not the case. Last week, the PCE inflation numbers fell back down to 2%, the Fed's target, on a quarter-over-quarter basis after the GDP revisions, and we also got the month-over-month in alignment with the expectations. Unemployment claims came in below the expectations, which is bullish, and durable goods orders soared back to positive, illustrating that consumers are still spending. But I can at least see and understand the too far too fast narrative looking to be contrarian up here. If you look at sentiment surveys, they show that market participants are feeling more bullish than they have all year, and the fear and greed index is right back to the extreme greed reading after Wednesday's quote historic stock market crash of 2023, according to the good folks over on Twitter. Oh, sorry, I should say X, the old bird app. Regardless, it is a good thing in Wednesday's episode we discussed not falling for the biggest bear trap of the year and reinforced it Thursday morning, not wanting to fall victim to HBS or become a bricked up bear. If you know, you know. Shout out to Yoshi on that one. We had some fun in the Thursday morning pre-market live stream. So remember that on Monday, we have a holiday. The market is closed. Happy holidays to all. And generally speaking, it should be a very slow trading week, but markets are still technically open, so let's build a game plan based on logic. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, we've got more of an indecisive doji with a bullish edge here. It's a change in character from this market. Notice that every other preceding bar here has very minimal lower wick, very minimal upper wick, even this one in relationship to the size of the candle body. So we're making note of the change in character, but nonetheless, the green close does strike me as being more bullish than bearish, so we will give the buyers the benefit of the doubt. In terms of location on the bar-to-bar count, we do have a substantial higher low, as well as a higher high, but notice the weekly close is right at the top of the previous weekly range. So again, we are giving benefit to the buyers here, but we're just making note of the character change. Every other weekly bar outside of this one right here was a more substantial close outside of the previous weekly range. Now, in terms of trend, we know the buyers remain firmly in control. There have been 0 pullbacks ever since the October low. If this change in character is going to suggest a pullback, which again, there is nothing inherently bearish about this price activity or location, we just broke to a higher high technically. But if there is a pullback, if the change in character is going to suggest a pullback, we know that there's plenty of reference points underneath us. The main one is going to be at 459, which is your prior weekly pivot from over here in the top of the daily balance area that we had broken out of just ahead of the FOMC meeting from 2 weeks ago now. In terms of Fibonacci's, we can come in from the low of the October move up to the most recent high, and what you'll notice is that the 38.2 is underneath this level that we had just discussed at 459, but if we were to extend that off to the left, it is confluence with prior weekly structure, and we also know that there's a daily breakout point at 451.10 in this general area right over here. So even if there is a very harsh pullback, something that looks like this, again, the market structure and location would not suggest that that is likely, but if we smash right through 459, there are still reference points underneath us, namely the 38.2. Let's bring out the, let's go anchored view apps actually, and what you'll notice is that these anchored view apps will likely not be in play for a very long time, but slowly the October low anchored view app will start to provide confluence around that 38.2, again, somewhere in the neighborhood of 450, 451 as of right now. Let's lastly finish it up here on the weekly time frame chart with the volume profile. And what we'll notice, as we've been noticing over the past couple of weeks, is just if we do get a pullback, right? Resistance, resistance, resistance now has the opportunity to act as support. Again, that number is 459, and it's also a high volume shelf, as you can see from right on over here. In terms of upside, we have cleared and closed over the high volume node at 471. We were tracking this as prior flat top resistance. resistance, as well as the upper wick from the green inverted bar. And obviously, again, this week we had closed above it. So that is another bullish data point. The only reference point that we have overhead to be aiming for is the all-time high in terms of actual structure that has printed. The measured move of the cup and handle, which we described on the Tuesday night episode, is always from the top of the cup to the base of the cup. And if we come in with the official Fibonacci extension coming from the base up to the top of the cup, and what we'll do is we'll give the bears the benefit of the doubt. We'll stack it to the bottom of the cup here, saying that this counts for a bulk of the move in the upward direction already. Not for nothing, the 100% extension is up towards 520. I'm not saying that we go here this week, next week, or even in Q1 of 2024, but it would illustrate that the buyers remain firmly in control on the higher time frame charts. On the SPY daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 479.55, and that of course implies a higher high. If we're contained by the lower bound, the number is at 467.79, implying an equal low to the bottom of this as a daily balance area. So for that reason, primarily the trend continuation via higher high, I would say expected move is bullish. The green dashed line is the visual for the Santa Claus rally stats we discussed in the intro, 7 trading days and 1.32%, taking us to a very, very, very nuanced all-time high, but it's just another reinforcing data point. In terms of the trend here on the daily time frame chart, we have lows, higher lows, higher lows. We know that these are our last higher lows, flipping into an hourly downtrend here, flipping into an hourly downtrend here, but we had pulled back from the highest high in the trend sequence, so the daily trend has not been jeopardized. In terms of what's going on, remember that markets move from expansion to phases of contraction. Expansion to a new possible phase of contraction over here. But all of this contraction is technically happening over a reasonable pullback area. If we do something that looks like this, coming in from the Thursday low of now 3 weeks ago, that is the origin of this breakout, right? Because that was the first daily higher low over that 456.30 level. And you'll notice that these lows are right at your 38.2 Fibonacci consolidation, classifying this as technically a healthy bull flag. So we would favor upside from that point of view. Another reason to favor upside is because of the failure of the sellers to capitalize on momentum from the Wednesday session. Obviously, we made an equal low for all intents and purposes. All they needed to do was make a daily lower high, and that was certainly not the case. If you look at what happened on Friday, we technically opened on a gap up. We produced an equal high. Intraday, there is a liquidation break testing into the Thursday session range, but we close back outside of the Thursday session range. Now, don't get me wrong. This is not a very, very, very bullish candle, but it certainly has bullish implications if you tell yourself the story. So if we're looking for an upside break, and this is a balance area, we know that we're usually looking for a doubling of the balance range, and not for nothing, but that would project a new all-time high, smashing through this as the sort of stat target from the Santa Claus rally. Now, if the market is going to turn in the downward direction, I wouldn't become a bear if we're just chopping around in this balance range. The bears really need, on the daily time frame chart at least, a violation of the lower edge of the expected move, the equal lows from back here. You need to bring in a daily lower low, some sort of lower high underneath, and then we will look for a weekly pullback. But if we are contained in this as a daily balance range, I really don't think that there is much of a bearish edge here. On the hourly time frame chart, you can see as clear as day the 100% retracement of the liquidation break from the quote stock market crash of 2023 here. And even the short-term hourly trend is actually in the upward direction. We have lows, higher lows, higher lows, highs, and higher highs on that Friday session. And not for nothing, but you could start to look at this through the lens of an hourly double bottom. And Thursday's low is a beautiful higher low retest of that neckline at 471.50. So the name of the game is fairly straightforward. If we're looking for bullish activity into this shortened holiday trading week, you ideally want to see continued consolidation over that as a line in the sand. It would also keep us in the upper 50% of this as sort of just a daily balance area. And generally speaking, if you can be in the upper 50%, obviously that is more bullish than bearish. So continued consolidation over 471.50, looking for breaks, higher lows over 475.50, targeting the all-time high, the upper edge of the expected move, and the measured move from the Santa Claus rally stats. Generally, let's just call it 480, right? 480 is what we're looking for in the upward direction. Now, what would be even better? Even better than this would just be high and tight consolidation over the origin of the liquidation break from the Friday session, right? We had this sort of double top happening over here intraday. We snapped underneath the opening print, got this little liquidation. If we can hold up over 473.75, what would that tell you? Short-term momentum shorts who got involved in this leg lower right here are underwater, and if they are going to close out of their positions, it should add buying pressure to this market. So high and tight consolidation, even better, even more bullish, looking for a break higher low than that 480 target that we had just just discussed. That's what the buyers want to see. If you're a seller in this market, you've got a long ways to go. You need to flip back into an hourly downtrend. How could you do that? You could either produce a lower high by consolidating here and then getting something that looks like this, lower high, 1 and 2, then an equal low breakdown gets you into the lower 50% of the daily balance range. But as we know from the daily time frame chart, you really only produce something meaningful underneath 468.50. So sellers, it's got to be a lower high here almost instantly, like opening drive lower, hourly lower high, break the equal lows. You sort of fall into the hourly downtrend more firmly when you get underneath 471.50. You need to break that in the downward direction if something more bearish is going to happen. Now, what are some supporting pieces of evidence here? Let's take a look at the intraday anchored view apps, and lo and behold, I mean, come on, right there at the anchored view app from the liquidation break high on the Wednesday session, from the FOMC gap up, double anchored view apps at 471.50. The name of the game on the SPY hourly time frame chart, higher lows keep us bullish over 471.50, even better, over 473.75, higher lows, boom, boom, we're looking for 480. If we snap underneath this, we know that we get confluence of support at 468.50 from the Thursday low anchored view app. If I just move this chart, there's your Thursday low, the origin of this entire move, that's confluence at 468.50. So not for nothing, but even if you do flip into an hourly downtrend, liquidation break or something, lower high, break for an equal low here, you are looking for support. I would be looking for support, hourly double bottoms, inverted head and shoulders, the whole 9 yards on a retest of 468.50. Now, eventually, you can only knock on the door so many times, right? Any sort of like first indication off of it for another lower high up against 471.50, yeah, here we're looking for lower, probably looking for that weekly pullback. But as of right now, based on what we just described with the liquidation break failing to really yield short-term momentum in the downward direction into the afternoon on Friday, I would tend to be partial in the upward direction as long as we're above that magic number 471.50. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it very simple. We know that we had a balanced week. We had a liquidation break on Wednesday, and then everything else balanced out. We have a daily balance area. Do these internals show a bearish or bullish edge? Net volume flows on the week positive. Let's just round up there and call it 300 million. How much time was spent over the zero line compared to under the zero line in the advanced decline line? What were the cumulative builds doing throughout the duration of the week, even with the nasty move we saw on Wednesday? You can certainly see that the buyers have the upper hand at the exchange level. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, what's going on with value area and point of control? Here is Thursday. Here is the Friday session, overall moving in the upward direction. The minor concern I have with Friday's point of control is if we do something that looks like this, this is the upper distribution, D1 we'll call that, from the Wednesday liquidation break. We know that this string of single print separates the upper from the lower distribution over here. But notice that the point of control on Friday is just ever so slightly underneath the upper distribution low. It's not the end of the world, but it would have been a nice nuance for that to migrate into that upper distribution. Regardless, we still have ourselves a poor high up here on that Friday session, so that is in need of a little bit of repair. Then we should talk about the lows of Friday's market profile. Notice that this was still a liquidation break. We knew that intraday, right? And the J and K period here really don't build out any value at these lower prices. The reason that that is substantial, right? This would basically illustrate that no one wanted to transact down there. It just means that momentum style sellers who clearly showed their hand on Wednesday were unable to do so again over here, right? There was no indication that stronger sellers were trying to hammer this and hammer this and hammer this inside of the Thursday range. And clearly, the value area and point of control moved back outside of the entirety of Thursday's range. So that, to me, is a slightly more bullish than bearish indication. Changing gears to the QQQ weekly time frame chart, what do we see here from a candle structure and location point of view? Much smaller wicks in relationship to the size of the candle body here, so not as indecisive as the S&P, but they're definitely still on there. We do have a green close, so I would say structurally buyers are in control. Bar to bar count, certainly a higher low as well as a higher high. The Qs actually closed more firmly up and over the previous week's range high. So overall 2 for 2 on the weekly count goes towards our buyers. We know that we're in a firm weekly uptrend. We are obviously in daily uptrends as well. We're trading in blue sky territories up here. If there is going to be a pullback, the first level I would think about on the weekly time frame chart is not actually the previous structure over here, but it's 392.75. That's this level right here where we actually broke out of for this most recent leg higher. Remember that you want to see prior resistance turn into newfound support on any potential pullbacks. This could still technically act as support here. It's the bottom of this as a weekly balance range and also the previous pivot structure over here. And if we come in with a Fibonacci from October's low up to the most recent high, if we extend that, obviously it's that same exact level. That's roughly in alignment with 384.50. If we bring out the anchored view apps on the QQQ, what you'll notice is the October low anchored view app, just like the S&P, will slowly, as time continues to pass, start to creep up and provide confluence around that 38.2. But just again, as a reminder, this bar would not suggest that a deep, dark, dirty pullback is imminent on the weekly time frame chart. Let's finish it up with the volume profile look, and then we'll use a couple of extensions as well, just to take some measured moves here as we're moving into blue sky territories again. Look at where we've closed. Right at those sort of new all-time highs, right? So volume profile, not really that helpful on the QQQ NASDAQ. I mean, if there's like a monthly pullback, maybe we're concerned with the highest volume spike down here, but there's not much to reference up near these all-time highs. Let's take out those extensions now and just do a quick discussion about what some measured move targets are. The same one that we did over on the S&P would look like this for your cup and handle, and that of course brings you much closer to in your QQQ. Let's just call that 476 for round number sake. We could actually take an even more nuanced one, and some folks do like your 61.8 on an extension as well. So maybe keep in mind 425 for the QQQ. But one additional measured move that we could potentially look at here is if this was a very, very like short-term bull flag, right? Something that did that. The 100% extension of that one is closer to like 434. So somewhere in this range might be the next weekly target that you could look for if that's your belief. You know, all-time highs, blue sky territories is the main target. Overall, I think that on the higher time frames, the buyers are clearly still in control, and we know what some rough targets are overhead. On the daily time frame chart, let's cover all the same indications. If we're contained by the upper bound of the expected move, the number is 414.75 in the Qs, and that of course would suggest a new all-time high and just a higher high breaking out of the daily balance range. If we're contained by the lower bound, this is where it's slightly different. 402.04 is the number, and that would be a very nuanced lower low underneath the bottom of the Wednesday liquidation break. So keeping an open mind to the QQQ, if we move in the downward direction, we could be in jeopardy of falling into a daily downtrend sooner than the S&P 500. On the hourly chart, I'll show you how this could potentially become some sort of double top, but we're not there yet. On the daily time frame chart, this is still very much so healthy bull flag consolidation. If we come in from that same Thursday low over here up to the most recent pivot top, obviously we've not even come close to your 38.2 after setting this high. Even the liquidation break from Wednesday came up shy from that number, which is technically at 401.17 in case you're keeping track at home. So for the most part, buyers remain in control of the daily time frame chart. Again, the sellers were unable to materialize on that momentum from Wednesday. And of course, on Thursday, we get a higher low back inside of a structural element from over here. Friday is a gap fill reversal, producing an equal high up at 410. On the daily time frame chart, if we were to double this range in the upward direction, that would of course suggest a move towards the upper edge of the expected move. Let's call that 415 for round numbers sake. If we move in the downward direction, yes, as we pointed out, if this is going to turn into a double top, we can bring in a daily downtrend with a break for a lower low underneath 404.25, lower high underneath, and then we'll start trading for downside outcomes. This is the origin of the FOMC breakout around $400 flat. Then anything deeper than that is the weekly pullback we had talked about around 492.75. That to me is really where I would put my thinking cap on for, okay, weekly pullback has been achieved. Can we find a daily trend reversal down here? Let's not talk too much about downside though, because again, all the indications up here would suggest that the buyers remain in control. We're looking for a new all-time high earlier on in this upcoming week's worth of trade, as it's a shortened holiday week. And let's take a look at the hourly chart. What's the hourly trend over here? It's certainly just like the S&P, where we're trying to move in the upward direction. We have lows, and higher lows. You could think of this as almost the same as well. There's your double bottom. It has better confluence with the two-day high breakout point from over here in the first place, and you can see we held it to the T on the Friday afternoon session. 406.50 becomes your big line in the sand from the balance area point of view. If this is the balance, you ideally want to hold consolidation anywhere over 406.50, keeps buyers in control. Even better would be recapturing the breakdown point from the Friday afternoon session. That number is at 408.65. So this is like rainbows and butterflies here. Then we'll look for a break and higher low over 410, right? So those are the upside situations we're thinking about. This is the rainbows and butterflies, and this, we could do something like this, and then ideally over time it tightens up, and then we get some sort of break. That would be decent as well. If the bears are going to make something happen, as we talked about on the daily time frame chart, this possibly could turn into a double top, but only when and if we take out that neckline at 404.25, and you can see that that's coming from this. This was liquidation break again, so not overly concerned with this. You can see how we hold it on that Thursday midday session as well. So if the sellers are going to make it happen, right, what do they want to see? First step, lower high underneath 406.50, set up the H pattern, set up a new hourly downtrend with a lower high, enforce break the equal lows, and then we are looking for that retracement to the origin of the FOMC breakout. The one last thing I'll give you on the QQQ here is the fake break in the upward direction, right? Look above and fail is technically an outcome for balance ranges. You could apply the same theory to the S&P, but if we do something like this, we take it out and we do not find a higher low over 410, some sort of lower high back down underneath the range would suggest a look above, that's this move right here, and a failure back in the range, that's this one right here. In the Qs, this would make sense because we would be setting a new all-time high, right? And then rejecting and pulling back. Looking back into the range with a lower high is bearish, and the target always is the bottom end of the range. It's one possible path to be thinking about, but again, as we'll see as we get deeper into the supporting evidence, we really don't have much of a bearish edge out there across all of the market indications, especially knowing what happened on Wednesday. Based on what happened on Wednesday, I think that short-term sellers have been taken out of this market, and in place, we'll have the natural buying activity of generally market participants push things in the upward direction. Let's take a look at the market internals for the NASDAQ side of things, and again, keeping it simple here, more on the bullish side or more on the bearish side? I don't know about you, but that one's pretty easy. Same thing over here. Much more bullish than bearish. Cumulative build is not as clear. I mean, definitely stronger on the Tuesday session. Wednesday's a little bit deeper. Thursday's okay. Friday's really not all that impressive, right? So a little bit more neutral maybe, and that kind of adds up if we're thinking about the fact that we only have a balance area over on the daily time frame. Market profile for the NASDAQ is almost a rinse and repeat of the S&P, but what you'll notice is that the Friday value area and point of control are completely inside of the upper distribution from the Wednesday session. So from that point of view, it does strike me as being more bullish than bearish. Again, just think about it like this. If this, because we know that this happened into the end of day, the liquidation break that is, if this was going to turn into overhead supply, what should have happened if stronger sellers were truly stepping up, they would have kept things inside of Thursday's range, and they would have rejected this as overhead supply. From a charting perspective, that would have looked something like this. We get the breakdown, and any attempts to get back through this level right here should have or would have been rejected if stronger sellers were entering this market. It simply was not the case. Also liking how this is mechanical from here, and now it's very, very close to the value area low of the Friday session. So far so good. Buyers remain in control even from a profile point of view. Lastly, for the broad market, we've got IWM Russell 2000 and the small caps kicking things off on a weekly time frame chart. What an impressive looking chart. I mean, wall-to-wall movement from the lowest low to the highest high, and some starting to break out of this as a weekly or even monthly balance area. In terms of candle structure and location, let's stay consistent in the process. You can see that we have ourselves a solid green bodied bar, unlike what we have over in the S&P and the NASDAQ. Very minimal upper and lower wicks in relationship to the size of the candle body, and overall on the bar to bar count, a substantial, magnificent higher low as well as a higher high, closing outside of the previous weekly range. So buyers certainly go 2 for 2 on the weekly count. This is looking like a very impressive chart. If we are going to truly be getting a breakout of this as a balance range, we could do the same thing, and really let's pick out some of the more equal lows, and then we'll come up to sort of splitting the difference of the highs of the monthly or even weekly balance. Remember that the classic rule is that when you break from a range, you typically look to double that range. Not for nothing, but that is a huge target on your IWM. You're looking at 236.10. I'm not sure that that's an all-time high. Yeah, just shy of the all-time high, but certainly back more firmly inside of this as an upper range on the higher time frame chart. So that is a good first step in the upward direction towards getting to blue sky territories. You got to start somewhere. And if this as a range can resolve in the upward direction, that certainly is more constructive as opposed to a headwind for the entire broad market as a whole. Let's take a look at some studies here, anchored view apps on the weekly time frame chart. And let's actually back this off to a multi-year chart. Let's go with 5. I think we can see the sickness high and low. Yeah, there it is. There is the low. And just zooming in on this, if there are any pullbacks, I mean, the anchored view apps are not even in play. I would firstly want to see like, okay, is this a mild weekly pullback, right? Can we get something that looks like that? I would start thinking about this as a weekly pullback around 190 as we discussed on Wednesday, right? So far, things are looking really constructive for the IWM. Certainly an opportunity for higher lows to continue the weekly trend, or if it's just going to break and go. I mean, we know what some upper targets are and the magnitude of the potential move happening over here. Let's go ahead and bring out, let's firstly go to the volume profile. So let's bring out the volume profile. There you are. And again, we want to auto zoom this and take a look at what we have in terms of structures. This is the top of the range, right? And we've cleared that. We've cleared that as of last week's close, and the next high volume node, I mean, not for nothing, is the midpoint of this big congestion up here, much closer to, let's just use round numbers, 220, not forecasting that we go there this week, next month, quarter one, none of that, just suggesting that there is a low volume void the market could rotate through sooner rather than later. It could take, the span of a year to do something like that. Obviously, something like this took the span of a year to get here. It might take the span of a year plus to get back up here. Not unreasonable, but again, when we're thinking about volume voids, That is a pretty substantial one that we're breaking out up and over as of the close of last week's session. The last thing we'll do here is take a Fibonacci from, in terms of retracement, from the bottom of the move up to the top of the move here, just to get an idea of where the 38.2 is. And that's much more in alignment with that 190 pullback. The reason I was talking about 190 is it was the right shoulder of this as a head and shoulders pattern. The 38.2 is ever so slightly underneath. And actually on the daily time frame chart, we do have structure closer to that 187. Let's take a look now. IWM expected move high is 206.25, breaking from this as a balance range, and the low is at 196.75, basically an equal low to the bottom of the balance range and the top of this gap from the Thursday session of multiple weeks ago now. So expected move is bullish from that point of view, much more similar to our S&P as opposed to the NASDAQ side of things. In terms of the daily bar, it's certainly an inverted hammer up here, suggesting that we broke over that Wednesday high but closed back inside. Remember that everything else was mostly a doji inside of that range anyhow. So the fact that we did produce a higher high does strike me as a bullish indication. And in terms of what that means for trend, the trend is certainly up. We just made a higher high, so any higher low pullbacks are welcome. Higher low pullbacks at this point, I mean, on the daily chart, ideal consolidation would look something like this over 201.25. I would just call that a range breakout. But if we do dip a toe back into the range, the key hold is at 199. 199 holds look pretty darn good for a low, higher low, looking to continue this move in the upward direction. Next targets overhead are 204.35 and 208. That would be above this week's upper edge of the expected move. If there is going to be a reversal, right, because the inverted hammer might suggest that sellers are stepping up near those highs, if there is going to be a reversal on the daily time frame chart, I would only be concerned about the Russell if we start falling into this gap, right? So if this happens, great, we're still looking at just consolidation sideways. If this happens, okay, that's a different story. This now all turns into overhead supply, and we know that there's really dangerous thin structure over here, which we can see on the hourly time frame chart. But before we go there, just remember that 187.75 made a lot of sense from the weekly time frame chart as a potential higher low on that time frame. So let's take it on down to the hourly time frame here and see what else we can learn. Again, on Friday's session, you'll notice that we had that afternoon breakdown. It hardly produced a new low of day. Then we closed back over the top of this level. This is the origin of the liquidation break from the Wednesday session. I feel like I'm going to overuse that word liquidation break, but it's just a great way to describe what happened. So as long as we're over that 201.25, again, this is the ideal, most bullish consolidation, looking for follow through in the upward direction. If we fall more firmly into range, you could still look for a higher low here at 199. I would keep an open mind to hourly reversal patterns like a double bottom down here, an inverted head and shoulders, the whole 9 yards that we're generally looking for. 199 is a key daily higher low, then trend continuation higher. The issue, as we were talking about, and this maybe is similar, you could start to use your imagination here, right? Maybe this turns into a man ray. If this breaks down and we get a lower high under 199, the big dangerous neckline is underneath 196.50 to open up that gap underneath. That's certainly a short trade. I mean, we're willing to trade this thing short if we break down through that neckline to retrace what is a gap, first and foremost. But even if we continue to look left, this is thin structure all the way down to that retracement on the weekly time frame chart. 187.75 was the number that we were just referring to. So what does this mean for the broad market, right? Because the IWM has really acted as a bellwether gauge for the S&P and the NASDAQ. If the NASDAQ's struggling and going sideways, but the IWM starts ripping up and over 201.25 in the upward direction, you're probably going to continue to trade longs over in your S&P. You're looking for that Santa Claus rally to basically produce a new all-time high. If the QQQ is ripping, but the QQQ is ripping, but the IWM is falling back down into range, I would still favor upside in the S&P, remembering that the tech sector is roughly 28% of the S&P 500. If both the IWM and the NASDAQ are falling, I would look out below in your S&P, but things would really only get aggressive, firstly, if IWM can breach and close underneath 196.50, looking for that gap to close, and then the thin structure underneath. It's not the end of the world from the weekly time frame charts, but on the daily, we would certainly have some shorts to be trading on your S&Ps and maybe even the NASDAQ as well. Let's take a look at the market internals for the Russell side of things. And what we'll notice over here is the same. I mean, I'm not going to beat a dead horse. It's mostly bullish as we were consolidating, even with the break on the Friday session. Notice that we had a stronger move over here. We got closer to the substantial volume inflows out of the Russell, and the cumulative build out of the tick is much stronger than what we saw on a relative basis compared to the S&P and the NASDAQ. So this is making sense that small caps are broadening the nature of the broad market rally. Let's take a brief glance at the market profile for the Russell. Russell, and I'm really pleased to announce that obviously your value area and point of control are in the upper distribution. We don't even really have a double distribution from the Wednesday breakdown, but it's certainly over that Thursday session. Thursday was fairly centralized, even from here to here. Point of control moves higher, point of control moves higher. These are sort of normal distributions, right? So very normal activity out there in the market. Lack of material excess at the lows means that it might need a little bit of cleanup down there, but as we know, there are plenty of reference points underneath, namely IWM 199, that can hold for potential support and keep the trend in the upward direction. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the communication sector led the pack up 2.27%. As we know, that is a bullish and risk-on indication. XLV Healthcare is just underneath, up about 72 basis points, and that's not nearly 2.25%, right? So just understand the magnitude difference between the two. The reason I say that is because we know that healthcare, it's technically the second heaviest weighted sector by market cap, but it's also D for defensive. The tech sector is green on the week, 42 basis points. At the bottom of the barrel, we see utilities and financials. And again, think about the magnitude here at the bottom. Utilities down about 146 basis points, XLF financials 3 basis points, all right? So it's not like we saw a big risk-off rotation as this liquidation break was taking place. Let's take a look at the structural charts and evaluate what's going on from a trend point of view. Over here in the XLC, I mean, it's pretty hard-pressed to say anything bearish about this chart. Any healthy consolidation that holds over 71.25. We're looking for the gap to continue to close overhead up towards 75.25. We'll be concerned if we flip into a daily downtrend and do something that looks like this, but as of right now, it is not the indication that we see here. Let's take a look at the XLV, what's going on with healthcare. Certainly holding just steady in this as an overall range. Remembering what we just pointed out, second heaviest weighted sector by market cap, but also D for defensive. This looks pretty darn good. You're not getting too much of a lower high rejection here and some sort of lower high double top breakdown through the neckline. The fact that Friday perked up does strike me as a decent look for holding the market sideways. Let's take a look at materials, really lightweight sector, the lightest weight sector for them all. Nice flat top. If it does break out to a new swing high, that would be a constructive look for the broad market as a whole. Here's the XLK tech sector, the heaviest weight and most risk on sector of them all. And what do we notice over here? Are you bullish? Are you bearish? I mean, come on. Come on. I mean, we've just got a very simple bull flag on the daily time frame chart. It's an exact same rinse and repeat of what we had over here. Eventually, the music will end and we will see a stronger weekly pullback. But until we flip into a daily downtrend, I am going to continue to dance to the beautiful sounds that are coming out of the speaker. So far, inside bars on Thursday and Friday session, clearing that all-time high blue sky territories, and that would be a bullish boost for your S&P 500. Let's take a look at industrials. Same thing I would argue as materials mostly, but this is about 8% as compared to like 2.2% that materials is. So flat top breaking out to new all-time highs would be a successful move for industrials that would help the S&P continue in the upward direction. Here's the XLP. D for defensive. It's also a lighter weight sector. Is this exhibiting leadership? Is there any concerns here? Absolutely not. Any upward pressure is upward pressure. It is bullish for the broad market, but we do not want it leading. It certainly is not leading. It suffered a little bit more of an aggressive pullback off of this instead of balancing up here like many other things and now looking for a break. So just a little recovery effort here would be decent for a rotation point of view. Let's take a look at the XLY, consumer discretionary. Again, hard pressed to say anything bearish about this. If this turns into distribution, we can still look for weekly higher lows, right? What's the key level? 175. We've been talking about that, right? So any sort of break over 182 back into the range with a lower high, that starts to set up a classic distribution pattern, right? Close this gap underneath and get a retest of 175. Look left. 1, 2, 3, sort of 4, right? The origin of this breakdown, which is kind of nasty for the end of the summer sort of pullback, if you will. So overall, I think we're in good shape here. So far, so good. These higher prices, this high and tight consolidation does strike me as more bullish than bearish. We'll change our tone if we break down. We'll look for pullbacks. That's fine. Again, we could trade either direction, up or down. And right now, I think that the buyers still have the upper hand. We're not looking for a big change in market sentiment. XLE Energy, it's been the laggard. It's sort of been going sideways. We know that there have been some issues with the Red Sea and possibly, impacting prices that way in terms of crude. So if this turns into an inverted head and shoulders, great. I would be looking for the higher low over 85.50 before initiating a trade here, simply noting that we are in a downtrend overall and you are bucking the prevailing winds for the most part. Let's take a look at, I was about to say industrials, but this is actually real estate. Industrial real estate, perhaps. Anyways, real estate is pulling back. And I mean, rates have sort of bottomed out, if you will. They are starting to go a little bit more sideways, and being a rate-sensitive sector, this really doesn't surprise me. But what is it? I mean, we just broke to a major higher high. We've undone all of this consolidation. This was a pretty nasty breakdown when rates got a little out of hand, and now we're up here, right? That was a little bit of an overshoot, but you get the idea. This higher low pullback looks constructive over 39, daily double bottoms, reversals, whatever. Even weekly pullbacks, monthly pullbacks over 37.80, good to go. What's the final say on real estate? It's an extremely lightweight sector. It's not going to make or break the market. if it does not hold this 39 in the coming weeks worth of trade. Next up, utilities. D for defensive. Is it doing anything impressive? The answer is no. This is always a rinse and repeat of consumer staples, depending on which one comes first. But so for the most part, this pullback, not concerned from a risk-off posture point of view. If utilities start breaking down and close this gap, I mean, could we produce like a weekly equal low? Maybe. We don't want it falling off of a cliff. That's the one last thing I'll say as we're breezing through the sectors today, is we don't want the lightweight sectors and the D for defensive sectors falling off of a cliff. We just don't want relative outperformance, and it's certainly not the case over here in utilities. So these upper wicks on Friday's session, at least, maybe a little bit concerned for a deeper pullback. I really wouldn't want utilities much deeper than this gap close overall. Otherwise, it's like, okay, what's going on over here, right? That's the sort of the issue that comes up. Financials, last but certainly not least, because this is the third heaviest weighted sector for the S&P 500, definitely more of a risk-on indication. We had the conversation about lowering yields, or we should say rates coming down, impacting the unrealized loss in the bond portfolios. That is a good thing, increasing the valuations of those banks, and so far so good, hanging out up here near these highs. The one thing I would say from a very nuanced perspective over on your XLF, let's zoom in on that end of week interaction. Notice that the liquidation break clears the flat lows from here, and this is thin structure. There was no acceleration, and notice what happens on Friday, right? We gap up, gap fill reversal, stays over the breakdown point. To me, that is a bullish indication. The more that we can hold 37.25, the more I would be looking for continuation in the upward direction. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, the XLK looks absolutely fine. This is a risk-on indication. XLF has pulled back mildly, starting to flatten out after producing a higher high. This is a risk-on indication. Same thing over here in the XLY, pulling back after finding a higher high in this trend sequence. All of this strikes me as risk-on. What about the risk-off sectors? XLV, it's trying to perk up, but remember, it's still underneath a downward sloping 50 SMA. The XLP is underneath a 50 SMA and just hardly perking up off those lows. Same thing over here in utilities. This is not a risk-off rotation. So far, we are A-okay with the pullbacks. If the pullbacks unfold in the first place, we're looking fine in the big three up here. It would be this trifecta. If we want to include communications, it would be better if we could get this up and over a now rolling over 50 SMA, but it is not the end of the world considering the structural chart that we were literally just looking at. Let's take a look at some specialized ratios here, and what we'll find is that the bullish nature of the market just continues. XLK over the SHY, so very risk on tech sector versus very risk-off government-backed treasuries in the shortest duration. I mean, just not even close, right? This is a risk-on look here. We could do the same thing, but increase the risk on the safe side by moving XLK to XLU, breaking out over this flat top. That is a bullish indication. All good on that front. And apples to apples, as we know, is the XLY consumer discretionary over the XLP, which is consumer staples, breaking out of this as a balance range, forming a new higher high. Any pullbacks that catch a higher low are good to go, and this is, again, an apples to apples comparison for a risk-on indication in equities down below. What about the dollar? Anything interesting with the dollar as we were trading around last week? Not really. Taking a look over here, the dollar's slightly lower, and remember that alleviates headwinds for equities down below. So the dollar moving lower, that seems to make sense currently. What about the gold contract? Let's take a look at the good old /GC, the futures contract here. One interesting thing, and this is kind of the one highlight of the supporting evidence category, right? Breakout in gold up and over this flat top, closes as an inverted hammer. What does the silver contract do? And recently we know, we want SI, not SO, SI, there we are. Silver has been leading gold, and what you'll notice over here is that we attempted to break out over this area, but we've already seen a sharp reversal bar, that red one, back right to the breakout area. It's closed right on it. So are we going to be trusting of gold moving higher? I would be a little bit reserved here. And again, what does that mean for the dollar? The dollar has the opportunity to make a tick in the upward direction. And I mean, not for nothing, if the dollar sees an uptick here, it's not going to change the trend, but it could mean a slight pullback for equities over here. So I would be watching that. It's the one sort of bearish path I can see forward for this sort of Santa Claus rally timeframe. Let's continue along and take a look at interest rates. What's the TNX saying as of right now? As we pointed out, rates have sort of bottomed a little bit. I mean, they're just not breaking down as aggressively as perhaps maybe a more appropriate comment to make here. But 38.30, this prior breakout level from over here, is a logical place. I mean, any opportunity for a weekly, daily lower high on any rebounds, good to go. We know that the inflation data is coming in favorably for the Fed. We know that we're not going to get a whole lot of data in this upcoming week, obviously, or even as we head into the early stages of the new year. But so far, I mean, this is not an issue for the market, right? If anything, this is providing a tailwind, not necessarily a headwind. What about the inverted ZT? What is the 2-year telling us about expectations for the Fed? Continuing to price in those aggressive cuts. Let's take a look at the tracker tool. Still 6 cuts. Let's find out. Yep, we've got all 6. They haven't gone anywhere, and everything's got higher than 50% odds until we get out to September of next year. But forecasting the Fed that far out, I mean, good luck. You'd be a bazillionaire if you could do that accurately. But anyhow, it's fun and games to joke about this stuff, but they have real-world implications. The promise of rate cuts drives a PE expansion rally. That's what we've gotten thus far. And if we take a look at the earnings estimates for 2024, we can see that they're not doing so hot, right? This has consistently moved in the downward direction. But let's just take that projection at 245.40 and go on out to a forward PE, right? If we take a look at this chart over here, this is the forward PE of the S&P. Now, we're not going down to the lower effective bound of rates. We're not talking about 0 to 25 basis points, but let's say that, we do get 6 rate cuts. This is going to drift in the upward direction. We're not going to here. Again, this is the lower effective bound, but let's just say that we get a 21 PE out of the S&P 500. I've done the math, and you should have heard this on Wednesday, right? Or sorry, Tuesday, but 51.53 is the projected target of the SPX. Fundamentally, if you use a 21 PE and a $245.40 EPS, right? And not for nothing, divide that by 10, you get your equivalent in the SPY. It's pretty darn close to the 520 Fibonacci extension we just projected on the weekly time frame charts. It's very interesting how the fundamentals may actually align with the technicals. And what about the risk appetite charts? TLT ratio to the S&P, of course, broke the resistance trend line, but is this an aggressive trend in the upward direction? I would argue no. It's certainly building in the upward direction, but we know that if we add in some more context here around bonds, especially in relationship to themselves, we're not actually getting anything that's all that concerning from a flight to safety style perspective. Sure, we're getting a little bit of rounding here, a little bit of rounding here and here, but for the most part, we've broken underneath the 50 SMA, same thing here and same thing here. The more that these move in the downward direction, the more confident the market is in longer dated risk assets. The most risky of them all is just something like a technology company, right? So that would speak to risk on for equities down below. Let's take a look at credit spreads because these continue to tighten up. They are moving in the downward direction. Trend is down, trend is down. A little bit of flattening happening here in the medium duration IEF LQD, but for the most part, still an opportunity for a weekly lower high, a rejection of the 50 SMA. I mean, we've moved pretty far, pretty fast. Wouldn't be unreasonable to get a little bit of a counter trend move here. What about the HYG in isolation by its lonesome? What you'll notice is we had a positive divergence from the HYG here, right, forming that higher low. We talked about on Wednesday how it was actually kind of ironic. Earlier in the week, it was suggesting, hey, we actually have possibly a double top here. It did not break to a higher high. And then it flipped. It changed tone and was like, no, actually, we're good. We're looking for bullish outcomes in the S&P that held true. And obviously, you can see here that so far, so good. We want to remain on the bull side of the market unless we sort of start to bring in a lower low underneath. Roughly 76, 75 is the level. If we break for a lower low there, and the S&P is still consolidating in range, we will concede and say, yeah, it's probably time for a weekly pullback down below in equities. So we shall find out, but for the most part, on the bull side of the market still. Let's take a look at Bitcoin, what's going on with the digital gold. This is a daily time frame chart. Now, the weekly chart just wasn't really providing enough granularity. So here we go, ascending triangle after a break of a previous balance range. This does strike me as a bullish look and a risk-on indication for equities down below. Not one-to-one, but certainly risk appetite remains strong. Let's take a look at market breadth. How are we doing over here? We actually made a sideways print over the zero line that is constructive, and this adds up considering what we had discussed already over in the IWM Russell 2000 and the small caps. Same commentary over here in the SPX A200R, printing an uptick actually, even as the market is just kind of sideways, very mild uptick, right? This is a bullish indication. Same thing if we take a look at the SPX A50R. This is now on a daily time frame chart, apples to apples down below, just consolidating high and tight in this perhaps contrarian zone. So if you're looking for a pullback, I mean, if this shoots higher than like 90%, it's a very, very rare indication. It's definitely bullish, but you could look for an overbought sort of pullback. But what do we know about trying to look for overbought pullbacks? It really hasn't rewarded anybody unless you literally nailed the top on that Wednesday session, which very few people actually did for a big intraday trade. It's just not worth it. You trade in the direction of the trend for the most part now. Let's take a look at what's happening from an equal weight point of view. This is very constructive. RSP equal weight S&P is over the top of the balance range. This is constructive for the rally continuing. Remember that as this lags, right? As this lags and is maybe down here, it just is continuing to reinforce the idea of concentration risk in the Magnificent Seven, if you will. As this continues to break in the upward direction, that risk, the concentration risk, sort of decreases. So technically speaking, your risk profile in the S&P gets more attractive, right? So that is looking good out of the RSP. Same commentary over here on the QQQE up top. That's QQQ NASDAQ equal weight and the NDX index down below, both breaking and staying above the previous balance ranges. The one thing that I do want to highlight here is the Dow Transports actually did a great job of sort of foregoing what could have been a nasty day on Thursday last week. If we take a look at this chart, right, clearly stair-stepping in the upward direction, things are looking good. But the Wednesday liquidation break yielded a much nastier looking candle out of transports. It would have been very easy to slip underneath that low, close the gap, and look for more price acceptance down here. It just simply did not happen. So as we know, when transports are playing nicely with the industrials trend, that does tend to indicate a healthier move in the upward direction. Let's finish it off with volatility. What's going on with our VIX? A little bit of a spike here as everything unfolded into the end of last week, or really just the Wednesday session. But we're pulling back. We're underneath 15. I wouldn't really say that volatility is an issue. The VVIX does remain slightly elevated, but nothing overly concerning. Remember that this is technically a healthy range for the VVIX. As we start approaching 75 and we're floored down 75, that really brings in the complacency effect. So this is actually a healthy place over in volatility of volatility. And if we take a look to finish it off with the VIX futures, actually I've got the skew for you today as well. There's an interesting note to make there. But deep contangos over here, contangos here in the 9 versus 30 day, and even the 1-day VIX. It spiked on Wednesday, but it was not high and tight like what we saw during the October drawdown when everybody was like, oh my God, the world's ending, right? It just simply didn't happen. We didn't find much acceptance up there. We actually moved lower on that Friday session. So lastly, this time I promise it's the last one. Then we'll jump into those core list of companies. I just clicked on the same thing. Let's try the skew. There is the skew. I just want to point out the aggressive move from this is a range, right? So we've moved from the top aggressively back down to the bottom. What would this tell you about the participants in the market, right? Everybody was like, oh my God, I don't trust this thing. The market's going to zero. We got that liquidation break and skew moves lower. What would that tell you, right? Basically, people are not, it's like we got that one day and that was it. Nobody right now is like, I think there's more to come, right? If there was more to come, this would remain elevated. And it's like, oh my goodness, everybody's still pricing in and buying hedges further out down the line. This speaks to tail risk over on S&P options. And we're just currently not seeing that. So overall, this is a bullish indication, the fact that this has moved lower so sharply. Apple kicks off the core list of companies, and is it time for a fall from grace? I mean, Apple is like the poster child of the market, and as of right now, it looks like it's getting a little bit of replacement treatment. On the daily time frame chart, we have ourselves a early indication of a head and shoulders, just basing this off of the lower high over here. We're moving with relative weakness to the broad market as a whole, not really performing, not staying in this as an upper balance range. So I would start to be concerned, or at least thinking about that and the implications for the market. Could we pull back? It's possible. Here we go. On the hourly time frame chart, this was beginning to become a threat of a double top, and we were underneath the neckline on Thursday's breakdown. Friday, we technically opened above, but we could not hold above that 195. The more time that Apple can consolidate underneath 195, the more we will look for the daily trend reversal off of the head and shoulders. If this is going to yield an hourly double bottom reversal, I would wait patiently for the higher low back over 195. As of right now, Apple is actually the relative weakness monster. Let's take a look at Microsoft. What's going on with Softy? This is trying to break the balance range. And in my eyes, Microsoft is trying to replace Apple in something like your S&P or even the NASDAQ 100 for now. Any continued holds of 373.50 are constructive. That is a break from the balance range. And then if you can clear the 3, what would then be equal highs at 376.25 trading in the upward direction, 379 is a target. And then we're looking at all-time highs, 380, 380. If Microsoft is going to flip in the downward direction, a failure back down into range, look above and fail, didn't really materialize all the way to the bottom, but breaking down underneath that 373.50, be my guest to chop it around in here. That's up to you. I would wait for the stronger indication short underneath 368.25. Next up, we've got GOOGL. What's going on with Google? Taking a look at the daily time frame chart. This is another sort of, possible replacement for Apple, just outperforming. I don't think Apple is getting enough love, not participating in any of the AI madness, if you will. And Google is really not all that far behind Microsoft. At least, the charts speak for themselves. As long as Google can stay over this level on the daily or even weekly time frame chart at 139, looking pretty darn good. Nasty inverted hammer on the sort of Wednesday reversal, right? But then on Thursday, inside bar on Friday as well. Looking for follow through up and over 141.50, yields higher prices at 143.50. Then the next target overhead is way overhead at 148.50. So overall, I think that, Google could do a couple of things and I would maintain a bullish stance, right? Obviously a break, bullish. Consolidation up here over 139, bullish. We know that there's plenty of room for an overhead target, right? When this finally gets in gear and we're looking at 148.50, just think about the risk reward profile of this. Again, you don't have to enter here. You don't have to take profit here. You don't have to stop here. But generally, the risk reward profile of staying here and then targeting that over time, there's certainly less downside risk with a clear out underneath 139 as compared to looking for a short here, right? So that would be my take on Google. And you could also think of this as a pie in the sky double bottom. If you're over that neckline, good to go in the upward direction. Let's take it on down to the hourly time frame chart, though, just to understand what some nuance might bring us early on in the trading week as it opens up on Tuesday, right? So here's a balance range. Very, very, very clear flat top. I mean, I've never seen a better looking level than 140, 150. I probably have, but you get the idea, right? Breaks higher lows, trading in the upward direction. If this breaks down, I mean, maybe there's a short intraday because this turns into overhead supply. But again, I would not flip to a short bias if we're over 139. We have to be aggressively under 139 lower highs. Then we'll change our mind to short. But as of right now, Google's looking pretty darn good. Let's take a look at Nancy. What's going on with Amazon? How's she doing today? Decent little recovery effort on Friday. The issue with this was that this was yielding a double top. There's one, there's two. We were underneath the neckline on Thursday. Friday, it just battled around that. So I would really wait for a stronger resolution of 153.25. If we can resolve it higher and we get consolidation that looks like this, I mean, how is it not just an ascending triangle, right? In the context of this breakout, let's go to the daily chart so you can see this, right? In the context of this range breakout, we're looking for further upside. So overall, bulls on parade for Amazon, but we at least know what we can watch early on in the week for better, clarity as to where that entry may be. So holds of 153.25 consolidation, then breaks over 155.25. If we resolve it lower, I would be looking for a stronger sort of pullback low to form at 150 or even here at 147.60. This would be less strong because we've already sort of done the dance around it in the past. But on the daily chart, 150 very attractive for a daily higher low above the top of the balance area that we just broke out of, right? Respect the two highs that we broke here. Good to go. 150 would be that downside. Next up, NVIDIA. What's going on with NVDA? If this is a daily double top, I just want to get this out of the way before anybody comments on it, right? You need a lower high and something that looks like this underneath the neckline. That's 460.50. That's also a breakdown of your daily 50 SMA. Let's take a look at the hourly time frame chart because this is the battle of two different stories. On the daily chart, sorry to flip back and forth so much, but this is a daily uptrend, right? That's first and foremost. If that's the daily uptrend, this is the daily uptrend, right? And this is a very short-term hourly downtrend. Lows, lower lows, lower lows. So if you want the daily trend to resume, you need to end the hourly downtrend, and this needs to resolve as a double bottom. If we can break up and over that 491.20 as a higher low, looking to trade in the direction of the daily trend, target 475 and then your all-time high. If this is going to stay as an hourly trend reversal in the downward direction, right, you could think of this as a channel, then you're looking for rejections and lower highs to trade to the bottom here underneath 484. Chopping around in here, I mean, be my guest, but this is pretty clear evidence that you probably don't want to get involved just yet. If you could pick off the long down here for the sort of second part of the double bottom, great, quick draw McGraw, but the better construction is looking something like this for a move and daily trend continuation. Next up, let's take a look at Metaverse. What's going on with Zuckerberg's Fantasyland and the ACL? Continuing to just drift in the upward direction. There starts to become a danger with drifting like this instead of breaking to big time higher highs. The issue is that you get longs trapped, longs trapped, longs trapped. They're just getting rewarded less and less and less. Think about a long building a position here. They're rewarded instantly. They're feeling pretty good. These longs are like, okay, we're drifting in the upward direction, but we're not really getting that big payday that we're maybe looking for. Let's take it on down to the hourly chart just to understand kind of how that's taking place, right? If this was a bull flag and we were looking for a breakout, I mean, ideally this would have done something like this on the Friday session. It just simply did not happen. So if we can clear and really start spending some more time and acceleration up and over 350, 325, I think the buyers remain happy, but any sort of just consolidation up here, I would start to think of this as a distribution, right? You have a failed breakout number one, failed breakout number two. All it will take is a move underneath 347.50 and you are looking for a deeper pullback. The main level to be thinking about would be 337.25. Now, when we get here, I would think about daily higher low, right? If we just go back down to the daily chart, right? Something that does this, boom, daily higher low here and here. We really have not flipped into an hourly downtrend through any of that. So we know what the thin structure retracement is. I mean, you could still look at 342 coming from back here, but as you can see on the way higher, we didn't really put much of a pit stop in there at 342. So this risk is here and then double bottom, inverted head and shoulders, the whole 9 yards, 337.25. In terms of upper targets, if we do continue higher, 359.50 and then 371.50 overhead. Next up, Tesla. What's going on with Mr. Musk and the Boring Company? Let's take a look over here. It's actually starting to feel like the rocket ship again. This is a daily balance range. Look above and fail, look below and fail. This consolidation over top does strike me as constructive in the upward direction. This is a beautiful daily higher low. We're not even going to go to the daily chart. Use your thinking cap. This is your daily higher low. So what do we want to see moving forward? Friday, not really an ideal day, right? You would have wanted to see hold a support of 253.25. Obviously, that was not the case, so we risk further balance in here, but I would maintain overall a daily uptrend. If we were to fall underneath 246.25, okay, this is all overhead supply. We have a failed daily breakout, and we're falling back down into the overall balance, this one, which sort of began the most recent pattern that's setting up here. And I would start thinking about daily look above and fail off of a double top pattern, right? Boom, boom. There's your neckline, starting to trade back down towards the bottom end of the range. If we can early on in the week get something that looks like this, ascending triangle, sure, flat top breakout is required up and over 258.50. Last but certainly not least is Netflix, and then I've got two additional trade ideas to share with you. Netflix, what do we see over here? Head and shoulders is the obvious pattern, but I would just, I'd be open to the idea that Netflix can find a higher low on the daily chart here. So, shorts up against this kind of breakdown point at 490.25 might be well located, right? Because you can put a stop right here, enter right here, and retarget the lows over here. But when you get to the retest of this level, remember what the daily chart looks like, folks. This is a very, very impressive trend in the upward direction. And this, as we know, I know it's not yellow anymore because we've closed a bulk of that gap, was a large overhead gap. So a weekly higher low pullback, a daily higher low pullback even, that holds that 481.75. I'm not convinced that you want to push your luck there until we actually flip into a stronger daily downtrend to start looking for shorts, obviously, in the downward direction. So back to the hourly chart. What does that mean, right? If we get some sort of pullback to here, I would be thinking about, if the drawing tool would work, all the classic indications there. 481.75. If we get there, rebound, and then produce a lower high and reattempt, this is where you look for the breakdown. You don't look for the break on the first test. You look for the second test after a subsequent lower high from a daily point of view, right? That is your downside. If we are going to flip bullish, I mean, that's a tough look. It's really a tough look until you get clearance of like 494. I will adjust that 02. You guys know rule number 2, round numbers only up here in the penthouse. Something that does this is constructive. That could be a long here as a daily higher low, but it requires some patience, right? You need to see the higher low outside of that 494.02. Getting all hung up on these numbers as we finish out the video. You can tell it's time for holiday break, right? Last but not least, two trade ideas. We're not even going to transition. WMT, Walmart is the first one on the chopping block. What do we see over here? Daily chart is going to kick us off. What do we see? Inverted head and shoulders, right? There it is, and we got a break on the Friday session, up and over the daily 200 SMA and up and over our neckline at 155.72. Again, round numbers only would say 75 is the proper penny to be watching. Regardless, higher low consolidation, looking for a thin structure retracement to target the daily 50 SMA and the prior pivot top from over here. If you take it on down to the hourly chart, you can see how this was nearly a vertical move lower, vertical in the downward sense, right? And some thin structure retracement is in order up towards that 158.85. This is a hourly bull flag. If you can break out of it, looking for continuation, higher lows, turn it into overhead supply, that's fine. Looking for higher lows here, something that does this, right? There's your sort of daily higher low retest of the breakout point. Then we're trading back in the upward direction. So that is Walmart, and that is number one. And number two is just a recap or sort of a continuation of PYPL PayPal from Wednesday's 10 trade ideas. There were 10 trade ideas in that video. Absolutely unreasonable. Double top still in force, right? The fact that we have a bearish engulfer on the Friday session as the broad market sort of tried to stay outside of Thursday's range is interesting to me. If this double top is going to continue to play out, we know we're looking for a larger retest of 60 flat. So there's two trades now headed into the end of the week. We were looking for, okay, let's see if we can just get there and then pick it up for a long. Now you could actually look for the short as a constructive move lower because you have a way to manage risk, right? If you go on down to the hourly time frame chart now, you can see how this was clearly a rejection. We've closed sort of weak here, breaking down through that level. You can start thinking about a stop here instead of just like trying to chase momentum off of the downside move from Wednesday. So 6180 is the number, breaking down from there. If we could get the drawing tool back, there we are. Breakdowns do 60 flat, and then when we get here, hourly reversals, right? Everything that we just discussed on the daily time frame chart holds true. Can we find a retest of that breakout level here for something that looks like this, constructive into the future? That's going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. I truly hope every single one of you has a wonderful holiday, be it Christmas, Hanukkah, Kwanzaa, any of the holidays that are out there during this time frame. Diwali, right? That's in the past already, but you get the idea. Hopefully you have a wonderful holiday season with your friends, family, spend some time away from screens, and we will catch you in the next one. Have a good long weekend.